Welcome everyone to this Prosper Social Finance webinar, Building Better After the Pandemic and an Introduction to ESG Investing. My name is Jay, I'm one of the members of the management team, and just welcome to today's session. It's great to see so many of you here today. To start off with, we're going to do a little bit of housekeeping just to get started. I just want to check whether you all can hear me. So I'm going to put a poll out, and if you can answer the poll, whether you can hear me and you can see the slides, that'd be great. That poll should be out. If you can respond, that's brilliant. Please ensure you're muted for today's session. Feel free to ask questions in the chat box. One of the management team members will pick it up. Seems good that everyone is able to hear me, which is brilliant. If there's any issues with Collaborate, please put them in the chat box or directly message Agliki, who's going to be dealing with those kind of issues. And finally, the session is going to be recorded and it will be uploaded to our YouTube channel, and you can find that and share it with your friends and stuff through our social media platforms. That's all from me for now. Let's get started and introduce the rest of the management team.
Hello, everyone. My name is Vicki Grant. I'm the Executive Director of Prosper. I'm going to be a fourth-year student. I'm studying economics and politics. And just as a little icebreaker, we're going to talk about some of our hobbies. So my hobby is swimming. I really like to swim in the beach.
Good afternoon, everybody. My name is James. I'm the head of training for the next academic year. I'm joined by Irem, who you'll meet in just a second. We've got a really exciting training program put together. So we look forward to meeting all the future training analysts we've got. In terms of my hobbies, basically anything outdoors, whether that's hiking, trekking, camping, or mountain biking. Pretty much just tempt me with anything that involves getting cold, wet, and muddy, and I'll probably sign up.
Hi everyone, I'm Clara. I'm head of social impact and strategic relations for the coming academic year. My degree is politics. I'll be a third year politics student next year, and my hobby has sort of become running during lockdown.
Hello everyone, welcome to our webinar. I'm Irem, and as James said, I am the other head of training. So I'm going to be starting my third year in economics and mathematics, and my hobby is windsurfing and anything that you can do in the sea.
Hello everyone, my name is Agiriki. My role at Prosper is head of operations. My degree is also economics. I'm going to be a fourth year student this upcoming year. And my favorite hobby is dancing.
And yeah, you've already been introduced to me. My name is Jay. I'm the head of strategy. I study chemical engineering, and things I like to do, I like to play cricket, I love golf, and I like listening to podcasts. That's all from me. With regard to, let me explain quickly the schedule for the program for today. So we're going to do an introduction to Prosper. That's going to be led by Vicky, and she's going to kind of focus on the effect of COVID-19 on the markets and what socially responsible investing is. James is then going to add to that further with an introduction to ESG and socially responsible investing. I'm then going to cover CSR and comparing that to ESG and what the difference is. We're then going to our main event, hopefully, with our speaker, Nikolaj Pedersen from the UN Principles of Responsible Investment. Agliki is then going to do a quiz, which is a quick fact quiz on ESG and social responsible investing. I then cover a case study on ExxonMobil and kind of they're an example of where greenwashing is prevalent. And then finally, we're going to kind of do a little overview of Prosper with understanding Prosper social impact, an overview of our programs and the recruitment process. And the last 10 minutes we will be a Q&A. That's all from me for now. If you have any questions, feel free to put them in the chat. One of the management team members will pick it up. And without further ado, Vicky, let's get started.
All right. Okay, so whilst many of you may know us a bit better, some of you don't, which is why I would like to introduce Prosper before I give some context to our webinar today. So we are essentially the UK's first socially responsible investment fund, founded and run entirely by students at the University of Edinburgh. So as per our mission statement, we aim to deliver positive social change in Edinburgh through responsible student-led investments. Now, what does it mean to be a socially responsible investment fund? For those of you who do not know, you're in luck, as my colleagues in this webinar will hopefully kind of delve into the concept more. So essentially, every single investment we make must pass rigorous screening, and it's kind of based on our 5 core values, which are shown in the screen, and our environmental, social, and governance criteria, which are commonly referred to as ESG criteria. Now, if you don't know what that is completely fine, as we will kind of run through that later on in the webinar. So we're not a student society, but we are a social enterprise, meaning that we are a company in our own right, and as any company, we have our own processes. Change the slide. Oh, sorry, we're experiencing some technical difficulties. There we go. Okay, yeah, so the Prosper process begins with our investment portfolio, which is underpinned by our ESG criteria and our core values. So it's through the investments that we essentially finance change by supporting companies that do good and supporting social enterprises and charities that do good in a different and perhaps more direct form. And as a final part of the process, we aim to challenge traditional perceptions of finance through our 2 programs, our events and our blog. So Prosper is essentially propped up by its analysts and senior analysts who become part of Prosper through these 2 programs. So for those of you who are interested in joining either of these programs, more information will be provided by my colleagues at the end of the webinar, so stay tuned for that. We also aim to engage the community as a whole by hosting events like this one and uploading as regularly as we can to our blog, which can be found on our website. All right. So now that I've finished this short introduction, let's talk about why we're here and why we decided to host a webinar with this title. So as you may know, we have experienced a turbulent first half of 2020, and it's been marked by a monumental event that has and will change our reality for the foreseeable future. So the COVID-19 pandemic has brought a lot of political, economic, and social distress to the world. I'm sure many of you may have been keeping track, but just as a reminder, there have been so far 18 million confirmed cases and 600,000 deaths. There's no doubt that this monumental event will cause monumental change. And in fact, this change has already been happening in the world of finance. So from the first months of the pandemic, major players in the world of finance were highlighting the importance of ESG investing in building better after the pandemic. Please, if you're able to read through whilst someone is speaking, then take the time to read through these quotes. In essence, what they're saying is that the pandemic has acted as a wake-up call and reminded us that we have to think of others not just ourselves. So apart from this reminder of compassion and altruism, which some of you may think has no place in the world of finance, the pandemic has highlighted the immense economic and financial consequences posed by high-risk and high-impact events. May I also remind you that within this category of highly probable and high-risk events are environmental disasters such as drastic loss of biodiversity and destruction of the ozone layer. So at this rate, those are increasingly probable. So in light of these 2 realizations, there's arguably been a shift in perceptions and priorities in the world of finance. So according to a study by Morningstar, within Q1 alone, which includes some of the most economically detrimental months of the pandemic, such as March, sustainable funds in the US set a new record of flows. This is shown graphically in the image that I have attached here. So also globally, there were net inflows to sustainable funds this year, which amassed at $45.6 billion compared to net outflows of $384.7 billion in the overall fund universe. Now, this shift towards socially responsible investing is not without realized benefits. The most important achievement in the world of ESG and socially responsible investing is that such funds consistently outperform their counterparts. In fact, globally, assets in ESG-focused funds outperformed their counterparts. ESG-focused funds, so for example, ESG-focused funds were down 12% in March compared to 18% of their counterparts. So to give you a more specific example, the Nuveen Large Cap Growth Exchange Traded Fund, which is an ESG large cap fund, has returned 10% this year. And by comparison, the S&P 500 is down roughly 1% for the year. So to further highlight the performance of socially responsible funds, and namely ESG funds, I have included this graph which compares the performance of ESG versus non-ESG funds in Europe and US regions. So I have essentially compared the major indices in those regions that measure stock performances. So I've included the S&P 500, which measures the performance of US stocks, and the FTSE 100, which kind of is used as a measurement of performance of UK stocks. So the orange line represents the FTSE 100 index in the UK, and the blue line represents the MSCI ESG European index. So as depicted in the graph, both funds faced a major fall in March of 2020. But may I point out that the MSCI ESG fund did not fall as much as the FTSE 100. And this is also the same when we compare the MSCI US ESG index compared to the S&P 500. And in fact, may I point out that the MSCI Europe ESG index has been significantly outperforming the FTSE 100 index, especially since May towards June. Now, how about Prosper's fund? Since Prosper's inception in June 28th of 2018, which is when we made our first investments, Prosper's portfolio is up 21%. By comparison, this figure was 13.1% in January of this year. So compared to the S&P 500 and the FTSE 100, Prosper's portfolio has yielded better returns to this date. Since June 28th of 2018, the S&P 500's return is 19%. In January 1st, this figure was 18.05%. So whilst the S&P 500 has only a 2 percentage point difference in return compared to Prosper's, the return of our portfolio has increased by 8 percentage points since the beginning of the COVID-19 pandemic. Now, I may be biased, but that's pretty impressive for a small fund like ours. Anyway, so now that I have bombarded you with facts and figures, let's go back to the question I posed in the beginning. Why are we here today? And for me, the answer is simple. The COVID-19 pandemic has reminded the world of finance to be more compassionate and selfless, but has also reminded it that high-risk, high-probability events like pandemics and environmental disasters can have catastrophic economic consequences. In this light, and with data to support it, socially responsible investing is seen as a bright future for building better. Hence, as avid supporters of it, we at Prosper feel that it is our duty to spread awareness of it to our community. Anyway, that is it for me. I hope you will enjoy the webinar today, and hopefully it motivates you to join the movement of socially responsible investing if you are not a part of it already. I will pass it on to my colleague, James.
Thank you very much for that, Vicky. So I know in the audience today we've got a vast range of experience. So what I'd like to do is kind of level the playing field and give everyone the background knowledge that they need to get the most out of this webinar. So firstly, what I'm going to do is explain what socially responsible investing is, and then go into a bit of detail on what ESG is as well. So since the first stock exchanges started in around the 1500s, the primary objective of shareholders has been to buy a stock at a certain price, and then after a given period of time, sell that stock for a higher price, thereby making a profit. Now, the premise of socially responsible investment seeks not only this value in terms of monetary gain, i.e. that profit we just talked about, but importantly, a value in terms of a positive social impact that the company might have on society. So to give a simple example, we take a company, Vestas Wind Systems. They're a manufacturer of wind turbines. They have a positive social impact in terms of providing green renewable energy, which lowers the need to burn fossil fuels and has a net benefit of society because there's fewer greenhouse gases, less pollution, and less pollution-related health problems, things like that. But they're also a well-run company with good, effective management, so have a strong financial case for investment as well. Now, the impact of our investment in these companies comes in, I'd say, two main parts. Firstly, it's a source of capital for these companies, in this sense, just meaning money. So when these companies issue shares to raise funds to carry out their business, that's one way they can do that. And secondly, when a company actively pursues socially responsible goals, socially responsible investors like Prosper create a demand for that stock, which drives up the stock price, again, providing a financial incentive for those companies to be more socially responsible. So in addition to this, as socially responsible investors, we take stewardship and engagement very seriously. So by investing in these companies, it gives us the opportunity to engage with them and express our concerns on how the companies run. Prosper does this through engagement letters, and as we engagement letters when we believe a company is not holding itself to the account of its values or mission statement, and also where we believe that things could simply be done better. Now, another term I'd like to cover is ESG, simply meaning environment, social, and governance. So what is ESG? It's essentially an analytical technique you can use to determine if a company is socially responsible or not. As it states in its name, it focuses on three key areas. When we look at the environment, the things we're looking at are issues surrounding sustainability and the possible negative environmental impacts a company has. If we look at social, that's things covering relationships with employees, with suppliers, customers, and the community in which it operates. And finally, governance, which covers things like executive leadership, transparency and integrity, and equality within that company. So to really understand ESG, I think we need to look at specific examples. And to do this, we'll look at how companies might have been affected by recent events. So ESG and current events. I won't cover this in a huge amount of detail as our fantastic guest speaker, Nikolaj, will be going into more depth on this. But if we start by looking at environment, many companies have put their environmental goals on hold as a result of the pandemic. So what we would be looking for is a continuation of their environmental goals and to make sure companies are not using the pandemic as an excuse to put them on the back burner. So something we might look at is whether they took part in the Lead on Climate 2020 summit, which focused on making the US build back better after the pandemic. One of the key goals of that summit was to have a net zero emissions by 2050. If we look at social issues, we'd examine things like the treatment of employees during this time, how the companies have looked after their key suppliers, whether they've treated them with a long-term sustainable view by maintaining relationships with suppliers and employees, or if they've focused on short-termism, broken down those bridges, which will lead to negative long and medium-term impacts. Finally, if we look at governance, not only has the coronavirus affected this, but also a significant spotlight has been placed on diversity and inclusion in recent months by the Black Lives Matter social movement against police brutality and racially motivated violence. This is obviously not a new issue, but what it does do is highlight those companies that are diverse and inclusive, and those companies that are taking the right type of affirmative action in order to correct the effects of both historical and current discrimination. Now, we would examine this by looking at executive leadership diversity, specifically in relation to companies in the industry, and also examining the affirmative anti-racist action policies that a company might have in order to promote equality of opportunity to racial minority groups, and then look at equal access schemes they might have as well. Now, if you have any questions on anything I've covered or would like to learn more, I'd urge you to sign up to our training analyst program. Of course, we'll be taking questions at the end of the webinar, so if you could hold them back till then, that'd be great. But for now, I'll hand over to Jay, who's going to talk about the difference between ESG and CSR.
Thanks, James. Now, looking at what CSR is, so CSR stands for Corporate Social Responsibility. By definition, it represents a company's efforts to have a positive impact on its employees, consumers, and the wider community. It's a form of self-regulation that most companies report on annually. It strengthens the bond between employees and organizations. It boosts employees' morale and makes them feel more connected to reality. So typical CSR programs include direct giving, philanthropy, volunteer efforts, and like volunteerism. So businesses are benefiting society while boosting their brands. But often CSR is done for brand and marketing purposes. It raises consumers and customers' awareness of the brand, and CSR helps to portray them in a positive light. They really are doing good for the community. The challenge is any company can perform CSR. They can produce a volunteering program that their employees can be part of, or give monthly donations to a charity they want to support. This means they don't actually address the problems within their business model and the way that they operate. So for example, in 2018, ExxonMobil donated 211 million to communities around the world, including donations from their corporation and their foundation. But for context, ExxonMobil had earnings after income tax of 14.3 billion. So by percentage, they donated 1.5% of their income to charitable causes. Now, looking at what the difference is with ESG, so the factors that James described earlier, and an example of those could be operational carbon dioxide emissions or gender pay gap data. These can be reported on by third-party organizations. ESG factors generally mean organizations have to embed these into the way that they operate. So for example, in 2019, Unilever announced that its factories, offices, and warehouses would now be powered by renewable electricity from the grid. And the reporting of these metrics helps us as investors make decisions on whether we want to invest in them or not. Many traditional investors are now employing these strategies because it helps them understand harder to quantify risks. The primary difference between CSR and ESG is CSR is internal while ESG is external. So CSR programs are internally proposed and executed. Companies can choose which programs and metrics they want to measure their performance by. They can stop and rework them. While with ESG, on the other hand, it's a measurement that analysts can use to objectively compare the effectiveness of different companies addressing ESG issues. Now, Prosper's view is that although they are similar in meaning and direction, CSR is often just added into business strategy to support brand awareness, and it's not necessarily part of their model. Green and social washing is a concept where companies try to convey a false impression or provide misleading information about how a company's products are more environmentally or socially sound. CSR makes companies appear more socially conscious instead of really addressing any ESG issues they may have. So for example, with ExxonMobil, they try to divert your attention from this through these surface level good deeds and paint the chimney itself green. So CSR is a mechanism through which greenwashing can happen. And Prosper believes that embedding ESG issues and factors into the operating model and into the supply chain and as many facets of the business as possible will lead to more sustainable growth, more controllable growth, and a more productive workforce and better risk management. Companies need to look beyond the bottom line and have a social component in their accounting statements as a means of measuring environmental and social impact. I'm now going to pass over to Irem, who's going to introduce our guest speaker.
Thank you. We are very excited to have Nikolaj Pedersen from Principles for Responsible Investment today to discuss further the implications of the current events for ESG investing and the future of the field. So before giving Nikolaj the floor, I would like to share some information about Nikolaj's background with you. Nikolaj Pedersen is the Senior Specialist in Responsible Investment Program at Principles for Responsible Investment, which is an international organization supported by the United Nations that works to incorporate ESG factors into investment decision making. So his role includes co-leading PRI's Human Rights Program and providing strategic advice on PRI's Sustainable Financial System Program. So before joining PRI, Nikolaj worked at a Danish firm and worked on human rights project coordination, where he developed a human rights policy and human rights impact assessment guidelines based on UN Global Compact and the UN Guiding Principles on Business and Human Rights. I would like to thank you, Nikolaj, for joining our webinar today and share your insights into socially responsible investing. Once again, welcome to our webinar. I now would like to pass the floor to you for your presentation before moving to our discussion around the questions submitted by our participants.
Thank you, Iram. Can you all hear me well?
Yep, I can hear you, Nikolaj.
Good, thank you. Just checking. Yeah, thanks very much for having me and for organizing this wonderful event. I've listened in for the last 10 minutes and it's been very interesting. I'll touch on some of the same topics I can hear. So I'll just start with my presentation, and then, as Iram said, we received some good questions. So I'll try and do justice to those and spend plenty of time to try and answer them as well. So I'm just going to start. I don't know what the sort of general knowledge is on the call about principles for responsible investment, but just a bit of background. We've been in existence for almost 15 years now, and were initially set up by the UN under Kofi Annan and a group of leading investors to address sort of the sustainability issues of our time. So we sit in an interesting place between the general UN system and the financial industry. We are a membership organization, and that means that financially the organization is funded by our members, so the financial industry. But at the board level, at the governance level, we also do have UN partners represented, and so they help set the strategic direction for the organization. The overall framework for what we do are articulated in 6 principles. They talk about the integration of ESG factors into investment process, stewardship, reporting, collaboration, and a few other things. So that has, since the inception of the PRI, been the main framework. But more than also this sort of, let's say, practical implementation at the individual investor level, we also do have let's say, a wider strategic purpose or a mission, which is really about ensuring that the sustainable system, or the financial system overall, is sustainable. So this means that in recent years we've spent more time on the policy and regulation that is in place to direct the financial system, and I'll come back to this a little bit later. In the next slide, you'll see that in terms of our membership, so just in the number of signatories, it's only grown and gone one way, and the same with the amount of assets. So a few interesting points. I mean, it's almost hard to see now, but actually after the financial crisis, we saw a lot more signatories coming in the next couple of years there. And as you can see, after the Paris Agreement as well, there's been a lot more momentum around responsible investment as well. We are now at a point in time where we have more than 100 trillion in asset under management represented by our signatories. And that, of course, means that the majority of capital markets now are managed by institutions that are our members and therefore commit to integrate environmental and social and governance factors to some extent into the investment process. Moving on to the next slide. So previous presenters has already touched on a number of different concepts in this space. So CSR, of course, or socially responsible investment. The framing we like to use at the PRI is the concept of responsible investment as the overall catch-all. And what we mean by that is, as I explained when going through the principle, is the integration of financially material ESG factors into investment process. But it's also the use of ownership or stewardship to influence the way that companies behave. But then also potentially a bit of an overlooked mechanism for investors is the public policy engagement that a lot of investors undertake. So what I mean by that is the conversation that actors in the financial industry has with government and policymakers about what the right frameworks are and what the right regulation is to facilitate the type of investment that we'd like to see. And so recently you might have become familiar with the concept of sustainable finance, which is very much about thinking about the way our financial system works. And in the context of the EU, which has been very progressive on this topic, what they are trying to do with the sustainable finance agenda is to align the policy objectives that European states has on sustainability issues, such as the Paris Agreement or the Sustainable Development Goals, and then financial regulation. So in other words, are the financial regulation actually encouraging capital flows that are aligned with those other policy objectives on climate, on sustainable development in general? And if they're not, what are the right mechanisms to then facilitate investment that would help to address those issues? And so we've seen that now with increasingly, there's something called the taxonomy for environmental economic activity. And so that's trying to quantify basically at the economic activity level which things we need to see more of in the EU and which ones we need to see less of. So for example, renewables, in order to meet the Paris goals, we need much more capital and innovation in that sector. The coal industry, on the other hand, or fossil fuel driven cars, for example, we need to minimize. And so those are not seen as environmentally friendly. And these things have been quantified. And what that helps us do is it helps us do labeling and benchmarking and general tracking of investment and whether they're sustainable or not. So I think this is a bit of a leap from this concept of responsible investment, which we focus on and which is at the heart of the industry, to, let's say, a world that's looking further than just ESG factors in a financial material sense, but looks to the outcomes or the impacts that the investment activities and the economic activity has on the real world. So we can speak a little bit more about that later. I have a slide here as well, just to, I know one of the previous speakers did as well, but just to help understand what we mean by the definition of environmental, social, and governance, which forms the basis for a lot of what we do. Of course, in the environmental space, climate change is the big issue of our time, but we also do work at the PRI on other issues such as plastics, circular economy, water scarcity, biodiversity. So there's a range of other factors here to consider as well. In the social box, I personally like to think of human rights, because I think there is a existing framework here. Now, Irem mentioned I worked on human rights in the past, but I think there's a lot we can learn from international human rights framework, essentially to help us understand what are the issues at play here. But the PRI has historically worked on labor rights. We've worked on diversity. We've worked on modern slavery, among other issues, and we've addressed these things in different industries, from the agricultural sector to extractives, and so forward. In the governance box, I think the previous speaker addressed it quite well. It's of course about the sort of overall governance of companies, but there are also issues such as tax or anti-corruption, which often falls in this bucket, and an issue like cybersecurity is increasingly getting prominence among investors. So an interesting thing which I thought it would be good to end on is to understand within this space of responsible investment or sustainable finance, investors of course have to deal with a range of issues, and it's a very challenging task, because these things are by no means static. And as we're living through both a health, economic, and social crisis right now, we're experiencing firsthand how these things can play out very suddenly and fundamentally change societies and our economies. And so at the PRI, of course, we have in the last couple of years been very focused on climate change. And if you're familiar with the World Economic Forum, they have over the last couple of years as well listed all of the issues related to climate change in the top right quartile, which are macroeconomic issues that are both high in likelihood and high in impact. And so those issues have obviously been given a lot of attention. Now you might notice here also that infectious diseases is quite high in impact, but was scored very low in likelihood. Of course, that's something that has played out, and probably next year when we're looking at a similar analysis will be potentially in the top right corner. So this is just to say that, of course, for investors to deal with these issues, they're required to both have a strong understanding of the direction that the world is moving in, some of the long-term trends, but of course it's also very important to have robust systems in place and risk management systems to understand things that are playing out as we speak. So
so before moving to the discussion, I'd like to thank everyone who have submitted their questions. They were all great, and it's very exciting to see your interest in ESG investing. So because of the time constraints, we unfortunately won't be able to cover all your questions, but we will try our best to ask Nikolaj questions around different aspects of ESG. And we will post the questions on the chat box as we go. So our first question to you, Nikolaj, is what are the changes you saw in ESG investing, and those like due to COVID-19? And do you think these trends are temporary or basically permanent changes to the way we live and invest?
Thank you. So I think the first thing to say, and one of the previous speakers already touched on this, is that Morningstar did a survey and which revealed that the inflow of capital into sustainable funds is substantially up in Q1 of this year. Now I think it's hard to say how long that will continue for, but if you noticed in that graph, we have actually seen a growth not only in this quarter but also in previous years. So I think there is a certain trend here which is much more long term. And one of the important reasons for this, of course, is that ESG funds have for a long time been recognized as being so outperforming over time, predominantly because they are better in more volatile markets. So they tend to protect against downside risk, and so better run companies tend to be better prepared for crisis, essentially, is the story there, I think. And so that's obviously why we see a lot of inflow now. And although these quite stark numbers are probably, they are not going to continue, I think there's a clear trend towards this type of investment. The other thing to say is that when engaging with companies this year, investors are facing quite a bit of difficulty because, as I mentioned, climate change is, of course, it's been front and center of attention for the investment community for quite a while. But I think a lot of investors are recognizing now, as we're going through a severe economic crisis, that companies simply need to manage or crisis manage some fundamental factors such as workforce, potential layoffs, changes in consumer behavior playing out very differently across industries, of course. So there is a risk here, but in some way also a recognition that investors have to accept that companies need to put some of those long-term strategies potentially a bit on the back burner. So it's a little bit tricky to see how that's going to play out. The last thing I would say is we saw a quite unfortunate trend towards, which is natural, but towards avoiding risky assets. But that came at quite a high price for emerging markets, both in the fixed income space as well as equities. So there was a sort of retraction of capital basically from institutional investors from emerging markets, and that has potentially quite severe socioeconomic consequences for some of those countries. So that's another thing which I think it'll be interesting to watch.
Mm-hmm. So, for example, talking more about the macroeconomic impact of COVID-19, do you think that the post-COVID recession will compromise the ability of investors to invest in a socially responsible manner? For example, do you think will they have to pay a premium to do so if they want to invest now?
Yeah, so I think as I mentioned in my presentation, if we use the PRI membership as a bit of a proxy for the extent to which signatories are undertaking responsible investment activities, it's really only going one direction, and we're still seeing that even in the first couple of quarters of this year. So there doesn't seem to be a lack of interest or lack of importance on this issue. I think it has really moved from like being a niche thing to a nice to have, and now it's fundamentally a hygiene factor of investment. So I think it's here to stay, and I don't think it will compromise. It might change the issues that are most prominent. In terms of the premium question or the cost question, I think what we've seen is with the sort of a surge in the number of ESG products, there's a lot more competition, and as these things are also starting to be integrated into conventional investment strategies, cost levels seem to be going down overall. And we've also seen some of the passive investment firms in the US, for example, launching passive products that integrates ESG. So that just offers investors that are going into the passive space alternative options at low cost.
Mm-hmm. So talking more about like the movement towards ESG investing and the greater role that the governments play, and also the big like investors have like impact on the government. So last month, a $1 trillion investing group chose to warn the Brazilian president Bolsonaro that his climate policies were producing an unstable long-term investment environment. So do you think this is like a fundamental shift in the wider culture in which socially and environmentally responsible investing will be the new norm and the effective way of pushing? Or do you think this is a once-off that can be largely ignored by the leaders?
So it's actually, so the initiative that you mentioned, which I think was led by Storebrand and was primarily around the issue of deforestation in Brazil, was obviously a very interesting one. But we actually track this type of engagement, public policy engagement, through our reporting framework, and we have observed a trend among our signatories that they are conducting a lot more of these activities, which is something the PRI has been advocating for around a good 5 years as well, that they should consider this part of their influence to promote responsible investment and to address some of the sustainability issues that states also play a role in. So it is a trend that started earlier and which we see continuing. Now, that being said, I think there's obviously a bit of a sensitive relationship in this space as well, because we don't want a situation. Let me put it another way. I think transparency is extremely important in these types of engagements, and making sure that engagements are aligned with the sort of international policy goals, international standards in this space, whether it's the Paris Agreement, Sustainable Development Goals, or human rights. Because if those things are not in place, there's a risk here that private capital can somehow, in a negative way also, we should not forget, influence the behavior and the activities and the priority of publicly elected governments. So I think that is something we always need to keep in mind. Governments are democratically elected, they operate on a mandate of the people. So as much as we like to see investors play a positive part on sustainability, I think it has to meet those criteria which I mentioned, because otherwise there is the risk that it can have a negative impact if it's the wrong priorities.
So, for example, like taking a slightly different approach and looking at the role that governments can play, do you think that like it is necessary that governments introduce mandatory reporting of ESG issues in investment practices? And if so, how do you suggest that they make companies more accountable for what they do and the impact they create? Can you hear me?
The voice was a bit lower, but I picked up your question, I think, around mandatory reporting on ESG issues.
Yeah, so if I repeat the question, it is about like government's role in the in the reporting. So do you think it's necessary that government introduce mandatory reporting and of ESG issues and investment practices? And if so, how do you suggest they make companies more accountable for the impact they create?
Yeah, thank you. I think this is a very important question. So, I mean, to make it short, yes, this is absolutely important. I think we need to distinguish between two different types of reporting here. The reporting by the financial industry is important. So what you refer to here as reporting on ESG issues in investment practices, and we are seeing stronger regulation in this space, not only about the extent to which investors are considering financial material ESG factors, but actually in the EU recently, we've seen a move within what's called the Non-Financial Reporting Directive, also introducing investors to consider the impact their investments have on the real world or the real economy, so social and environmental impacts from their investments. So that's the first part, and that is obviously very important. But investors cannot do this unless they have the right information from companies. So the next space, which is extremely important, is that the right regulation exists so that companies are sharing information which investors need to make their decisions on sustainability issues. And there's obviously a range of ways that this can be done, for example, through stock exchanges requiring that companies listed on their exchanges are releasing information about climate change or human rights or anti-corruption or whatever it might be. Again, in this space, and I'm sorry I keep referencing the EU, but in the EU they've been extremely progressive on a range of these issues, and they are right now discussing introducing mandatory due diligence on human rights. So this is already implemented in France under the vigilance law, but the EU is talking about rolling this out more widely. And this is just one example of, within the ESG space, of an issue that if this type of mandatory due diligence is introduced, well, then companies will start to disclose information to regulators. Investors can use this information to assess the risks present. They can use it to benchmark, and they can use it to make the right choices, both in terms of their investment decisions, where they allocate capital, but also in terms of the stewardship activities, the conversations they undertake with companies, and hopefully the improvement that they're able to facilitate that way.
Thank you. So we now have a question more about the role of PRI and the impact you work to create in financial field. So one of our participants asked, the PRI has a significant number of signatories, but only a fraction of them can truly say they meet the criteria 100%. So how does the UNPRI balance wanting to make the credential accessible to potential signatories and raise its awareness and profile, whilst ensuring it remains credible as a code that means something and forces managers to improve?
Thank you. So I personally love this question because I think as an initiative, we should be subject to scrutiny about whether we are actually fulfilling the mission that I laid out in the beginning and whether we're being successful. So I think the skeptics out there would say that with this graph that I showed you with signatory numbers and asset under management just going in one direction, and we just read the news every day and we see carbon emissions also unfortunately continuing to go up, in other words, going in the wrong direction, there is a discrepancy between international organizations such as ourselves working to address these issues and the impact we are able to have in the real world. So I think these types of questions are absolutely legitimate. The activities that the PRI are undertaking to change things, the conversations we're having with regulators, the change we're trying to affect in signatories, these are things that takes quite a bit of time, which also has to be recognized. And of course, as much as we try and push for some of these issues, there are potentially some fundamental challenges in a global economy that until this year has continued to grow and expand, and the potential footprint that has on the planet. So we're fighting against strong forces, in other words. But I do see the PRI getting stronger on these types of issues. So we introduced minimum standards a few years ago. That was the first time that we had expectations of our signatures above and beyond just reporting. and of course paying your fee to the organization. So we started introducing some governance requirements. I would personally say that that falls very short of where we want to be. And so now we are increasingly in our reporting framework moving from policy and process to outcomes focused reporting, again to try and make sure that the activities that our investors are undertaking and their contribution to these sustainability challenges is credible, and that we can track whether they actually do identify the main risks in their portfolios, whether they address them, what is the outcomes of stewardship activities. I think for too long, investors have been able to say, yeah, we're engaging companies, but when you ask them 5 years down the line and you see very incremental change, well, can they continue to justify these engagement activities, or is there a point where there has to be a much more forceful decision taking place? So this is a very long-winded answer to say that we are trying to balance being an initiative that operate globally in countries that are only starting to be familiar with these issues, and with a lot of financial institutions not very familiar, while we recognize that we need to do a lot more to push both our signatories but also regulate the industry more widely.
Thank you for your answer. So the next question, and knowing your background in human rights and also reading more about your blogs on Black Lives Matter movement, I want to ask you, how much of a negative impact do you believe a lack of racial and gender diversity can have on a company? And what are the key ways in which a company can address these issues?
Yeah, so there's been a lot of academic research on this topic, not only on race, gender, but like diversity in general. And to my limited understanding, I think the results are mixed. So I guess my starting point for this question, and similarly, the PRI is launching a program on human rights very soon, is a little bit different. So traditionally, we have our starting point on each ESG issue has been the business case. So how financially material is this issue? I think what we are slowly changing approach to is that some issues, it doesn't really matter whether they're financially material. We do have responsibilities as private actors under international human rights standards to address these issues, irrespective of whether they're financial in the short, medium, or long term. And when it comes to issues of race, as we've seen raised with the Black Lives Matter movement, or other types of human rights issues, I think we're dealing with a range of aspects that investors simply need to deal with. And so that's not to say that they are not financially material. I think it's very hard to argue that a private sector that doesn't address issues of race, that doesn't address gender diversity, that doesn't address other human rights issues, is long-term the most sustainable and profitable private sector we can have. I don't think you can make that argument. I think these things will play out, and over time they will play out. And actually, the crisis we're going through right now, and the difference you can see to the extent that different countries and governments are able to deal with these issues, I think really shows this. So some countries have been slowly undermining labor standards, the right to unionize, health and safety concerns, payment of taxes by the private sector over time. And those countries, I think, are the same countries which are now really struggling, because the moment you enforce lockdown measures, these companies are simply not resilient. In other countries where these things are much more protected, companies and governments are able to work together, and the impact on companies, at least in the short term, are much more minimal. So again, this is a long way to say that I think what the PRI is really trying to do on issues such as race, is what you're asking, Irem, is to change the mindset and say there are certain responsibilities of institutional investors which, irrespective of their mandates and of course their risk return objectives, has to be met. So it's really about the integrity of the way we conduct investment activities, I would say.
Okay, and we have another question about diversification. So basically, just like in all fields of investment, diversification is also crucial in ESG investing. And so we are wondering about the bond market as well. So although Prosper right now only invests in stocks, we are working to expand our portfolio into bonds and sustainable markets, other sustainable markets. So we want to ask you, what are the key issues in the sustainable bond market, and what steps need to be taken in order to solve these issues?
Yeah, so when we talk about bonds, we make a distinction between so of course sustainable bonds, which have a very specific aim, whether it be renewable energy, and conventional fixed income analysis on conventional bonds, which we also argue should consider ESG analysis. So, but to address your question, which I think is much more about the sort of bonds that are labeled sustainable or green, we know that the main issue is really, I guess, how do you compare these different bonds? So in different countries, there'll have been different standards and different types of measurements to track how the capital is used and what the outcomes are. So I mentioned the EU taxonomy earlier, and that is really, as I said, trying to quantify economic activities and whether they align with the EU's green policy goals. So there was a group called the EU High-Level Expert Group on Sustainable Finance. What they recommended was that on the back of this should be used as the source of information for the European green bond market, as a recognized standard to sort of set the right criteria for what the bond is going to deliver and document impact. And so this is just an example as a green bond. And of course, there's talks about SDGs bonds as well. And in the EU, they are considering developing a social taxonomy. So that would be a similar endeavor, trying to see if we can create a bridge between European policy goals on social issues and economic activity, thereby allowing investors to develop these types of products, social bonds, for example, and being able to quantify and easily compare those bonds between European countries. And we are, of course, hoping that globally, other jurisdictions will take this on as well, because investors, as they invest globally, will be as interested in being able to compare these products across markets.
So also one other question that we've received a lot from our participants, because all of us are students or recent graduates. So what changes can we make in our personal finances that could contribute positively to ESG, and like what changes can we make in our lives that can have an impact as well?
Yeah, good question again, which I'm sure we all think about. I guess it depends a little bit on your exposure. As students, you typically don't tend to have a pension savings already, but hopefully as you start to enter the job market, that's something you'll soon be familiar with. And that's obviously one of the main vehicles where most citizens are exposed to financial markets. So of course, remembering to ask your pension provider what their approach is, make sure they have good disclosure so you can keep track of development over time. It is a space that's seeing significant innovation. I guess if you're fortunate enough to have spare savings that you can invest, of course, a variety of platforms will offer you options, ESG options and responsible investment options. So I personally find it quite hard sometimes to differentiate between what these products actually does. It is a bit of there are a lot of buzzwords around, and sometimes you do suspect that investment firms are just using the right words, but actually how different are the activities underneath. So I don't have an easy answer to this conundrum, because I really think it is a problem for retail investors. But I guess as you're educating yourself in the field, you'll be better suited than most investors to dig through, I guess, the jargon and understand what the most sustainable products are. So that's just to give you a few examples.
So, and our last question is, like, I'm sure this will be of interest of like many of us here. What is your advice for anyone looking to pursue a career in responsible investment?
Yeah, so I'm happy to answer that. So
I think we lost connection with Nikolaj. He is trying to reconnect, so he'll be here with us in a second.
Yeah, sorry about this.
Nikolaj, yes.
Can you hear me again?
Yes, we can hear you.
Oh, good. Yeah, I got kicked out just for a second there. I don't know where you lost me, so I'll just start from scratch. I don't think I managed to say a lot of words before I got kicked out. But yeah, on the sort of a career advice or on responsible investment, I was just sharing that, you know, working at the PRI, we're 150 people now. And if I look at my colleagues, we come from very different backgrounds. And I think that says a lot about the responsible investment industry, what it really is. It's in many ways an intersection between finance, of course, but also a range of sustainability backgrounds, and also different approaches, whether it's political science, it's finance, it's law. And so I think I would encourage you to be curious in your career. I think to be versatile and to have had a few different experiences are quite important. Of course, a good grounding in finance is quite key to understand the way finance works, but it's equally important to understand, I guess, different sort of sustainability issues, whether it's climate or tax issues or whatever it might be, and to be critical about the way finance works as we know it and how these issues play out. Because the financial sector, if we look at the way it operates right now, we take a lot of it for granted, and of course there's a lot of very solid theory, Nobel Prize worthy theory behind the way that we conduct investment nowadays, but it's really a very young industry, perhaps not more than 50 years ago, at least not in the sort of global sense that finance works right now. And so I think sometimes we treat it with a lot of dogma and you know, maybe not enough creativity in terms of how it could work and how it should work and how we can align finance with society. So, you know, I would encourage a sort of a critical approach, a curious approach, trying to have different experiences in your academic and professional lives early on. I think that will benefit you hugely as we trying to address issues that are multifaceted and very complex in nature.
Mm-hmm. So thank you very much for answering all our questions, and thank you as well for being here with us today. So it was very great to hear your insights about the future of ESG, how the current events have impacted socially responsible investing, and also learn more about PRI's work in the field. So thank you very much for being here with us.
Thanks very much, Irem. It's been a pleasure.
Thank you. We hope to see you in our future events as well.
Yeah, likewise. And have a good evening, everyone.
Thank you, you too. So I now pass the stage to Angeliki for our practical task.
Okay, so let's move on to an ESG related quiz. Just posted on the comment section a link. So if you can please go and click this link to be transferred to the quiz, and let me know in the comment section if you're experiencing any difficulties. I'll just wait for a couple of seconds to get everyone in. I'll just wait for a couple of seconds. Okay, can you guys respond to our poll if everyone is ready with the quiz? We have 24 participants and we are 35, so I'll just wait for a bit. Okay, I guess we'll start. Okay, so the first question is an easy one to start the quiz with. So what does ESG stand for? Is it environmental, social, and governance, ethical, sustainable, and green, or ethical, sustainable, and governance? This is a silly question given this whole conversation so far, but it's okay. More interesting questions will come up later. Yeah, great. Okay, next question. So the next question is, when was the term used for this time? So was it 1967, 1992, 2005, or 2014? That's more of like a guessing question. Okay, great. The majority has voted 2005. This is the correct answer. And in fact, the term ESG was used for the first time in a landmark study called Who Cares Wins in 2005. So let's move on to the next question. So which of the following options does not fall under the category of social? And the options are human rights, child and forced labor, health and safety, transparency and disclosure, employee relations. And one of them does not belong to the social category. Yes, correct. The correct answer is transparency and disclosure, since this belongs to the category of governance. For the next question, we have by how much did the amount of US assets under management invested in ESG portfolios grow over the past 2 years? Right, the correct answer is 30%, which is quite impressive. And now the next question is, well done to Ryan. Next question is, which of the following is not true about ESG, SRI, and CSR? So we've mentioned all of them briefly in our presentation so far, so you should answer that. Right, so statement B is false. ESG measures a company's activities to reach a precise assessment of its actions. CSR, on the contrary, represents a company's efforts to have a positive social impact, but mainly for marketing purposes. And yeah, ESG is meant to be part of the broad range of criteria which we use in order to conduct socially responsible investing. Okay, moving on, next question. The process of conveying a false impression or providing misleading information about how a company is environmentally friendly called CSR, ESG, greenwashing, or impact investing. Oh, great. Yep, that's correct. And as Jay mentioned earlier, CSR and greenwashing are related to each other, but CSR is often used as a greenwashing mechanism. So like that's their relationship. Okay, the next question. Which industry comes second as the world's largest polluter after energy? So is it production and manufacturing, transportation, agriculture, or forestry and land management? Okay, so transportation is the right answer, even though it's quite easy to get it wrong. It's not that obvious, but transportation and energy go side by side. And in fact, transportation makes up 28% of total greenhouse gas emissions. Next question. The fast fashion industry produces how many garments annually? That is quite sad. Oh, okay. Yeah, I mean, 5 billion would be even worse, but it is producing 1 billion garments annually. And fast fashion is one of the most distracted industries, as you might know, emitting over 1.2 billion tons of greenhouse gases annually. So the next question is, so that's second to last. In Southeast Asia, more than how many people move towards other parts of the world due to extreme climate conditions? So is it 0.8 million, 2 million, 8 million, or 1 billion? Right, the correct answer is 8 million, which is quite devastating. It's a quite devastating number depicting the huge issue of climate migration. The New York Times magazine actually posted a very interesting article on that. Okay, and the last question is, companies with high racial and ethnic diversity among their employees outperformed their counterpart companies by how much? Actually, yeah, it's not 20%, it's 35%, which is quite impressive. That's why we are here today to talk about ESG. Right, so this was the end of the quiz. See the results. Is V Vicky? That's unfair. Okay, this was the end of the quiz. Hope you guys enjoyed it and found it interesting. Yeah, now I will pass it over to Jay, who is going to talk about a case study on ExxonMobil.
Thanks, Egliki. So yeah, this is going to be a case study on ExxonMobil, an oil and gas company who I'm trying to look at an example of greenwashing. So ExxonMobil have some renewable energy programs. Two of these, for example, is one, turning algae into biogas, and two, focusing on carbon capture from traditional fossil fuel plants. In a commercial that they aired in 2016 during the Olympics in Rio de Janeiro, they had 19 employees talk. 12 women and 7 men talk about these programs. I want to mention here that Exxon's executive management committee at the time was 100% male. So this could potentially be an example of social washing, where they are misrepresenting their organization. And also, looking at these renewable programs, Exxon's market capital is basically their net worth is $400 billion. But the algae biogas program was $600 million. So as a percentage, it's only 0.15% of their market cap. This is a prime example of kind of greenwashing. So highlighting through the marketing and pushing these renewable programs through their marketing and PR teams is a perfect greenwashing mechanism. It's highlighting that small, minimal positive environmental impact that they're having, when in actual fact, ExxonMobil are an oil and gas company focused on oil exploration and extraction and refining. And so from an environmental perspective, they just fundamentally are not very sustainable, as oil is a fossil fuel. And it's these kind of programs and mechanisms that paint that chimney green whilst allowing the smoke to be emitted. I'm now going to pass over to Clara, who's going to describe our social impact. We have two parts at Prosper. We have an investment stream and we have a social impact stream, and they're both equally important. So I'm going to pass over to Clara now.
Thanks, Jay. As you all now know, hopefully, our motto is to deliver positive social change in Edinburgh through responsible student-led investing. Therefore, as important as it is to understand our investment strategy, knowing why we do it and what we hope to achieve is equally as important to us. Prosper has both an indirect and a direct social impact. Our indirect impact includes our 10-week analyst training program, which is our most direct means of delivering positive impact within the university. Since our inception, Prosper has trained over 80 students from the University of Edinburgh, ranging from first years to master's students. We've also invested £20,000 in 18 companies so far. Our direct social impact includes our senior analyst program. Our senior analyst this year helped theorise a financial literacy program set to be trialled at Edinburgh Women's Aid, a social enterprise that helps support women who have escaped abusive relationships. This program was set to be implemented after Easter. However, in case you didn't notice, the world went crazy because of COVID-19, forcing the country into lockdown, and this has now been pushed back until next semester. Our analysts have also been panellists at Future Asset Roadshows, an initiative that encourages high school girls in Scotland to express. I'm now going to pass on to Irem, who's going to talk to you about our other programs.
Thank you, Clara. Yes, I want to talk a bit more about the training program, which I and James run this year. So training lies at the heart of Prosper Social Finance, and we welcome students from all backgrounds. You do not need any existing knowledge of finance, as our 8-week training program will provide you with the skills you would need to run an ESG analysis and financial analysis of a company. So each week we cover sessions around different concepts such as ESG analysis, financial evaluation, accounting basics, social investment, business and macro analysis, and many more. It's a great experience if you would like to learn more about social responsible investing, but it's also a great experience if you would like to meet lots of like-minded people.
Now, Prosper is so much more than just its training analyst program. Obviously, that's very good, but by signing up, it gives you access to a whole world of possibilities from all our engagement events, like the Scottish Money Week Fair, our charity events like the Sleep in the Park we had in George Square Gardens a year ago, to a range of hosted speaker panels like this one and guest lectures, which, as well as a huge number of really fun social events and the inevitable bonding and cohesion that happens when you surround yourself with like-minded, socially conscious people that are driven and enthusiastic about the work they can do together. Right, I'm just going to hand over now to Agliki, who's going to talk about the recruitment process. Wrong, I'm not going to do that. I'm going to hand over to Clara to talk about the senior analyst program.
Thanks, James. Yes, so I briefly mentioned our senior analyst program before, but I'm just going to go into a little bit more depth about what it is we do. Our senior analyst program is available to Prosper's analysts who have undergone the analyst training program, which is what James and Irem just described. The Senior Analyst Programme is designed to expand analysts' knowledge of Prosper's investments and its processes as a fund and a social enterprise. Rather than working through a syllabus, senior analysts work on projects which may relate to all areas of Prosper's operations. Senior analysts work closely with the management team with great independence and have the opportunity to make their own impact on Prosper's activities and future direction. At the beginning of each semester, before applications for the programme open, the management team announces 2 or 3 projects which the senior analysts will complete during the semester. Throughout the semester, they are guided by the management team, but complete the majority of their work independently and submit the final product at the end of the semester. Since new projects are announced each semester, senior analysts can be part of the Senior Analyst Programme for as many semesters as they wish. The programme is also designed to allow senior analysts to be part of the programme in non-consecutive semesters. Future projects include the Financial Literacy Programme mentioned earlier, designed to show our analysts how important knowledge of personal finance can be, as well as a great way of delivering direct social impact to the Edinburgh community. I'm now going to pass on to Agiliki, who's going to talk about the recruitment process.
Right, thank you, Clara. Right, so for the Edinburgh University students in the audience who are interested in joining our analyst training program this semester, our applications will open on the 21st and they will close on the 24th of September, which is the Thursday of week 1 of classes. So keep an eye on our social media pages during this time for updates about recruitment. You can also sign up to our mailing list, which you can find on our website, as we will be sending information there as well. So you will need to fill in a short application form with a few questions where you will have the chance to explain to us why you want to join Prosper as an analyst and why you're interested in ESG and in general in what we do. Successful applicants will be called in for an interview on the 26th of September, which is the Saturday of that same week. And after this whole process is done and the team of 25 analysts has been formed, we will have our induction day on the 4th of October, which is the Sunday of the following week. During our induction day, we will explain to you everything that you need to know before you start our training program. And then, of course, our weekly Monday meetings will start on Monday, October 5th. If you have any questions about the recruitment process, our programs, or anything that we have mentioned during this call, we will now have a short Q&A. But of course, you can also send us an email with any questions that you might have. But before moving on to the Q&A, I just wanted to say congratulations to Victor for winning the quiz, which I accidentally thought it was Vicky. Congratulations, Victor. Thank you for knowing so much about ESG. Okay, and now let's move on to our Q&A. Do you guys have any questions at all about recruitment, senior analyst program, analyst training program, ESG related questions? All right, please, if you have questions, send them in the chat. Or you can raise your hand and ask.
Okay, so question 1 is from Khalil. How would you separate? So the format we're going to use quickly, just to explain, is I'll read out the question and one of the management team members will pick it up. How would you separate candidates in the application stage and what do you think helps us stand out?
Right, so my advice would be, I don't know if anyone else would like to add anything afterwards, but we basically want to see like the extent to which you are interested with ESG, if you like what you know about Prosper and basically why you want to join Prosper, what has driven you to join Prosper in this in what we do. Just be yourself, like be honest. In the interview, The people who will be selected for the interview, you will have the chance to do that in like even more. Yeah, like I don't know if anyone has anything to add. And of course, there is no need for any previous knowledge of finance or ESG. Just we want to see that you're interested in these topics. Like you don't actually have to know all of that stuff, because we are going to train you during the analyst training program.
I'd like to add to what Agiliki said. So what we want, what our aim is to create a community of like-minded individuals who are passionate about the same things that we are passionate about. And that is why also a major thing that we're looking for people who join Prosper is their values and whether their values align with ours. For us, it's more important. It's not necessary for you to know everything about finance, the economy, social issues, or politics. That's not important. That's not the most important thing to us. And as Agiliki said, we will train you through the fundamental things. So we're just looking for people who are themselves passionate about learning more and passionate about genuinely making a difference and using finance to do that.
So Ross asks, hey guys, great presentation. Just wondering, what is the source of the funds under management? Clara?
Yeah, I can take this one. Thanks for the question. So we've invested £20,000 since 2018. The money comes from the University of Edinburgh's sustainability department. So we were given a grant of £50,000, which comes in £5,000 instalments every semester. So if you say get involved in semester one, the first year, will be allotted £5,000 to invest, depending on the stocks that come in and the pitches that we get in that semester. Prosper works on a 5-year investment horizon, so at the end of the 5 years, we take the profits that we've made from those investments and we reinvest them in the Edinburgh community. Hope that answers your question.
Yeah, and Tamara and Milan ask about how time demanding is the analyst training program and what is the expected time commitment. So I believe, you guys can correct me if I'm wrong, but I believe we've defined it as kind of being like a relatively easy 10 credit course in terms of workload. Realistically, you probably need to spend 3 to 4 hours a week on your work during the semester. However, it will change with time. So when you get closer to the end of the pitch, end of the proposal. So we have an 8-week training program. Every Monday we have a 2-hour session, and the induction day is compulsory, and the 2-hour sessions are also mandatory on a Monday. They were on a Monday night last time, but obviously that might change with time. And in terms of independent study, normally takes 2 to 3 hours a week of your time. However, that will change once you get closer to the stock pitch proposal. So at the end of the 8-week training program, you pitch a stock to the investment panel, which is comprises of the management team, and you get out as much as you put in, really. So the more time, I found that the more time that I put in, the more I learned about metrics, accounting analysis, and also just general ESG criteria. So yeah, that should answer your question. As I said, so when you get closer to the stocks and the pitches, you will need to put more time in, and that's like quite an intense 2-week period. But before that, it's generally 2 to 3 hours a week independently. Are there any other questions? Okay, Khalil asks, would you say the interview stage is more to get to know you? James, do you want to take that one?
Yep, of course, no problem. So the interview stage, really, what we don't want you to be worrying about is trying to make yourself out to someone you're not, and worrying too much about, they're going to want me to have all this assumed knowledge of finance and economics. That's not what we're looking for. Really, what we're looking for is someone that's going to approach the training program with enthusiasm. They're going to work well in a team. They're going to be driven throughout the process and really commit and jump on the bandwagon and kind of go where Prosper's going, rather than someone that studies economics. Or we kind of pride ourselves on our diversity. When I went through the training program, we didn't have a single analysts studying. There were no two analysts studied the same subject, which is quite impressive. So it's not about your financial knowledge. It's really about, are you going to work well in a team, and are you going to commit to the process and kind of enjoy going through it?
Definitely, if you can show your passion to the cause, that's more important to us than kind of having presumed an initial knowledge. Any more questions before we wrap this up? Sounds like none. That's the conclusion of this webinar. In terms of next steps, make sure to follow us on our social media, so Instagram, LinkedIn, and Facebook, and Twitter. Yeah, and that's where we post all our updates, so you'll get to know timelines for things and deadlines for applications as well. Will be notified through our social media channels. This session has been recorded, and it will be on YouTube. There will be a link in our social media channels, so you can feel free to access the webinar. The certificate will be issued after this. Agliki will get through those in the next couple of days, so you should receive that. We know this webinar hasn't been perfect, but we're interested to get your feedback, so we will be sending out a feedback form over the next couple of days. If you could send that back to us with some feedback, that'd be really good, because we do intend on hosting more and more webinars with guest speakers. So thanks very much for your time. If you enjoyed it, make sure to share it with your friends and spread the word of Prosper. And feel free to contact us through our email channels, operations@prospersocialfinance.co.uk. That's all from me. Thank you so much for listening and being part of this webinar. We look forward to seeing you soon.